What's up, y'all? Today I'm going to show you my favorite indicator to use when I analyze crypto markets. And I promise you, using this indicator in your strategy is honestly going to make you so much more accurate and is going to help you time the markets way better than before. So, the indicator that I'm talking about is none other than the stochastic RSI. Now, go up on TradingView, all you gotta do, search this up, Stochastic RSI, and that's the one I use. In terms of the settings, these are my settings, but um, I would say that it might be better to put this at 100 and this at 0. And see, that's only because these are the maximum bounds the RSI can go. So before we even get started, we need to find out first what really is the stochastic RSI. And it's important to note two things. Number one, it's a lagging indicator. So this means that it doesn't give you real-time market knowledge. It's a little bit lagging in it. And number two, this is a momentum indicator. So it shows the strength of trends. So the lagging means this is not real time, and momentum means the strength of market. These are two important things to keep in mind when it comes to the stochastic RSI. Now that we've got that out of the way, let's talk a little bit more about the indicator itself. Firstly, since it's a momentum indicator, it shows you when the market is at full strength and when the market is at the bottom or least amount of strength. So it ranges from a value between 0 to 100. So this is very key. When stochastic is at 0, this indicates that momentum has bottomed out, and when it's at 100, it indicates that the momentum has topped out. So from this, what we can gather is that when we see stochastic at 100 or 0, that means a reversal is incoming. So now that we've gone over those very basic concepts about RSI or stochastic RSI, now let's look at the actual indicator. So as you can see, setting it from 0 to 100 kind of helps us see when the momentum of the market has topped up or bottomed down. And there's a couple things here. You'll notice, generally speaking, whenever we have rising RSI, we have rising price. So this is kind of a coincided. Momentum's going up, price is going up. And over here, you can see price fell, so did the momentum. And when the RSI bottoms out, usually a reversal follows suit. Looking at kind of just, the chart right here, you can also see that you can't just trade based off the stochastic. If you took along here, which would be right here, you would see even though the stochastic is going up, price was actually going down, and you would have gotten wrecked in your position here. Same thing over here. If, for example, here you took a short, well, price rallied up all the way to 100,000 because the stochastic just kept pushing back up. So any one of these, you took a short, you would have been wrecked because even when it went down, price was still going up. And this is an important concept called divergence. So this is another one of those concepts when it comes to stochastic. This is a major player. Divergence is essentially discrepancy between price and an indicator. So a bullish divergence, so bull would be that at the same, so let's say um, at 100 stochastic, Bitcoin is at 99K, and then the next time we're at 100 stochastic, Bitcoin is at 100K. So at the same level, we have a higher price. A bearish one would be the opposite. So let's say at 100 stochastic, Bitcoin is at 100K, and then the next time it's at 100 stochastic, Bitcoin is at 99K. So at the same stochastic level, price has actually gone down. Now, this concept works both ways. So if we have, for example, the same price, so at 100K, we first have uh, stochastic at 100, but then at 100K, we again have stochastic at 80 this time, let's say. This would be considered a bearish divergence because at the same price, we have two different levels of stochastic. Now, the next thing I want to talk about is waves. So, a wave in stochastics is when something like this occurs. Let's go back to our example we use over here. You can see right here, if I just erase these lines, that the stochastic went to 100, went down, and around the halfway point, pushed back up, and did the same thing again. If it does something like this is considered a wave. And in this case, it's bullish because obviously, you know, um, price is pushing up and stochastic is remaining at these high levels. Like momentum isn't decreasing. The market wants to push higher. And you always have to look at the stochastic as a way of like it's showing the momentum of the market. If the stochastic is continually pushing up, momentum is continually pushing up. And you want to look at it from that perspective. And that's kind of a really bullish thing because market is the market's direction, the momentum is picking up over and over again in an upwards direction. But the same thing can happen on the downside. So, for example, right here, this is a smaller wave, but nonetheless, this is still a wave. Push up, didn't work, push down, and then eventually pushed up. But then look what happened. When we went to the top, price barely moved. So that's another thing about waves. They indicate to you the upcoming trend. So if you see a bearish wave, you can expect bearish momentum. And if you see a bullish wave, you can expect bullish momentum. And like, let's go back to that same example, right? Over here, we did that bullish wave. Price shot down to zero and obviously kept going up. And even though we had a small correction, look at the overall direction of the market since then. We've just been going up. No matter the stochastic, we've just been going up ever since that wave, right? And over here, after that wave ended, we corrected. But then after we got this wave, we went back towards a positive direction. Now let's talk about the um, double tops and double bottoms. So there's two different things. There's the waves, and then there's the double tops and bottoms. This is an important distinction to make. A wave oftentimes happens kind of like this, but a double top will look more like that and fall through, you know. And this could also be a triple top, honestly. And I'll show you guys some examples, but and a triple top would kind of look like this, this, and then a smaller and go down. Whereas a wave kind of is like an equal footing. Um, for example, like over here, this you could consider a triple top, right? So stochastic pushed up once, twice, thrice, and then kind of fell down. And you see the market retraced with it. And conversely, the bottoms, they kind of are a bullish thing, so to speak, right? You've got momentum pushing down, down again, and then price kind of starts soaring up a little bit. So this is an important distinction to make, and honestly, the double tops and bottoms, you're gonna see these more on the lower time frames. So your 30 minutes, your 1 hour, and your 3 or 4 hours. Personally, I like to use the 3 over the 4 hour. So this is another important distinction to make when it comes to RSI. Now, we need to talk about one big thing, and that is that RSI, stochastic RSI, at the end of the day, it will show you nothing other than the momentum. And when you want to take positions with this indicator, you need to look at, you know, are you going to take a short when the market is, the momentum, I mean, has topped out? Or are you going to take a short when the momentum has bottomed out? Like, if you think about it like this, when the momentum has bottomed, so there's no more momentum in the market, this indicates reversal, right? So this, like, works both ways. If it's topped out, it could reverse, and if it's bottomed out, it could reverse. And you just don't know when, because at the end of the day, this is a lagging indicator. But what you do know is that if you were to take um, a short position when the stochastic has topped out, right? You know that there's not much left for the momentum to go. So you start looking for the opportunity to short. But that doesn't mean as soon as they're 100, oh, I'm going to short from here. No, that's not how it works because this is a lagging indicator. You need to wait, see, okay, our price was here. This is our barrier 109. Let's see, where can our resistance be? Use other tools, use other indicators. And if you had, you'd have noticed that, okay, it came close to 109, but you can see that this kind of acted a little bit as support, 106K over here. And this was your opportunity right here. And it got supported by the fact that the momentum had topped out. So you had an opportunity to short here, but you didn't have an opportunity to short over here while the market was pumping. So you want to wait and use it as an indication that, okay, the market is ready to be shorted, or the market is ready to be topped. So a reversal came over here, but was actually like from the stochastic, it was given to you over here, right? So always make sure you aren't solely relying on this. This is what I mean. You need to use other indicators. Use the Ichimoku cloud, Keltner channels, EMAs, and even average true ranges. Like these are all good indicators to use alongside the stochastic RSI because this is nothing more than a confirmation, right? At the end of the day, you cannot trade based off of a lagging indicator. You need to use it kind of as confirmation rather than a entry exit point because all it's telling you is a reversal is going to come, whether it's on the positive direction or the negative direction. That's all it's showing you. So now staying on that topic, we're going to talk about one more thing, and that's going to be extended stochastics. You can see over here, the stochastic stayed extended up here and bottomed out over here, right? Like for a long period of time, if we just zoom into the stochastic, you can see that it stayed flat around 0. And over here, it stayed flat around 100. And this can happen often, especially on the lower time frames. And these are the biggest indicators of market dynamics, right? When you see the momentum has bottomed out and is staying below, that means that there's no momentum picking up. That's a pretty bearish sign. And if you see that the momentum is high right now and um, is staying high, I mean, what's more bullish than that? That people are buying and they want to keep on buying. The market wants to keep on moving in the direction it's moving. And you can see, right? Like we had this big extension of the stochastic followed by a big retrace in price. I mean, we went all the way from 102 to 90,000. And then same thing over here, right? We had this small extension, but that small extension paved the way for such a big push up, right? Over here we extended, over here we had that small extension, and look what happened. Market went up all the way to 110,000. So when you see these extensions, this is another indication of momentum either bottoming out or topping out. And it's another example of why you should not just trade based solely off this. You never know when this thing is going to extend because it can extend for a long period of time, right? Usually it's about like 7 to 8-ish candles. That's how long it kind of extends for, but it could go on for even longer than that. But at the end of the day, this indicator is such a powerful tool because it shows you, it literally tells you that a reversal is coming. Look for a short. A reversal is coming. Look for a long. It's telling you that. And especially when you look at the higher time frames, right? So let's check over here. Look what happened here, right? Let's go back here. So, firstly, look at this. So we had our stochastic over here, momentum went up, but it didn't go up quite all this way, right? And then indicated that, okay, maybe time for a reversal, and then the market dropped, right? And you can see the next time the stochastic went up, you can see like same price, lower stochastic, lower price, same stochastic. So these are the divergences we're seeing. So divergence, divergence, and then you can see right here, stochastic pushes up, and then we see market pump, but then at the top, we have a double top happen, and boom, market crashes, goes back to 0, tops, goes to 100, not quite, but you know what I mean? And then look right here what happened. We had that wave I was talking about occur. And right after that wave, not that long, we get a small extension, and then all of a sudden, market starts skyrocketing. So use this indicator. This indicator is going to tell you when you need to look for those opportunities. This is your opportunity indicator. It is your confirmation of reversals are occurring. Look for the opportunities. So let's go back to this. What are the key takeaways, right? Number one, this is a lagging indicator. Number two, it is a momentum indicator. Number three, stochastic goes from 0 to 100. Number four, use it as confirmation. It is a confirmer. Number five, use it with others. So don't use it alone. And finally, look for divergences and for waves. Now, this is kind of a beginner's guide, right? Like, I'm really just trying to introduce this to you and my thought process when I use the stochastic RSI. I'll make a separate video for a more in-depth guide on how I'm going to analyze a market using this tool alongside others. But this is just a way for you to reassess your own analysis and incorporate this tool because I promise you your accuracy is going to go through the roof. Thank you for watching. Share this, comment below what indicator you want me to cover next, and if you have any questions, feel free to comment that below. Also, I have a community of traders online in my free Discord. Obviously, you guys don't have to pay for anything. I'm not trying to sell you a course. Everything is free. And if you want to learn how to trade and put in that effort, join us there. I promise you it's going to be rewarding. Have a good day.